Did the approval of spot Bitcoin U.S. ETFs trigger the recent crypto rally? This is the question on everyone's mind after a staggering crypto rally, primarily led by Bitcoin, took the world by storm. Since the approval of these ETFs in January, we've witnessed a significant shift in the market. Crypto's total market cap has surged from $1.5 trillion to a whopping $2.4 trillion, marking a 60% increase. Let's put this into perspective. Despite this impressive growth, crypto remains a nascent and niche asset class. Its size is only 1/10 of gold's market cap and is dwarfed by tech giant Microsoft, which boasts a market cap of $3.1 trillion. The approval of Bitcoin U.S. ETFs was met with a fair share of skepticism. Many naysayers predicted it would be a classic buy the rumor, sell the fact situation. However, the massive price rally that followed proved them wrong. Instead of leading to a sell-off, the ETF approval seemed to fuel the crypto rally even further. US ETFs alone have attracted inflows of approximately $19 billion. The BlackRock IB ETF has been particularly successful, becoming the fastest ETF to reach $10 billion in assets. In just 2 short months, this ETF has amassed more Bitcoin than MicroStrategy has since 2020. Such large inflows have upset the supply-demand balance, leading to an increase in the price of Bitcoin, the underlying asset. Bitcoin ETFs in the US account for about 4% of all Bitcoins in circulation. Couple this with the fact that nearly 29% of all Bitcoin supply hasn't been touched for over 5 years or maybe lost forever, and it's clear these ETFs represent a significant source of demand. So, what's next for Bitcoin and the crypto market? That's the burning question. But one thing is clear. The ETF approval wasn't a buy the rumor, sell the fact situation as many predicted. It was a game changer, a catalyst that sparked a rally like no other. And the world watched in awe as Bitcoin led the charge. US ETFs have attracted inflows of around $19 billion. What does this mean for the market? Let's delve into this. The approval of spot Bitcoin. US ETFs in January was a pivotal moment in the world of finance. It led to a staggering crypto rally, with crypto's total market cap soaring from $1.5 trillion to $2.4 trillion, representing a 60% increase. Among these US ETFs, the BlackRock IB ETF stands out. It has become the fastest ETF to reach $10 billion in assets. In just 2 short months, this ETF has amassed more Bitcoin than MicroStrategy has since 2020. Such large inflows have created a supply-demand imbalance, driving up the price of the underlying asset, Bitcoin. Interestingly, US Bitcoin ETFs alone account for approximately 4% of all Bitcoins in circulation. Now consider that nearly 29% of all Bitcoin supply has been untouched for over 5 years, or might even be lost forever. This untouched or lost percentage of Bitcoin supply is significant as it further amplifies the demand, creating an even greater supply-demand imbalance. It's worth noting that these ETFs are not just sitting idly in portfolios. They represent an increasing source of demand in the market. This current supply-demand dynamic is set to intensify even further when the Bitcoin halving takes place in mid-April. For those unfamiliar, a Bitcoin halving is an event where the reward for mining new blocks is halved, meaning miners receive 50% fewer Bitcoins for verifying transactions. Bitcoin halvings are scheduled to occur once every 210,000 blocks, roughly every 4 years, until the maximum supply of 21 million Bitcoin has been generated by the network. Historically, these halving cycles have acted as a psychological catalyst for price increases, igniting rallies not just in Bitcoin but also in the altcoin market. So what can we expect when the Bitcoin halving takes place in mid-April? Well, if the past is any guide, these demand-supply dynamics are likely to intensify. Institutional investors are pouring into ETFs, while retail investors prefer buying coins directly. What does this mean for the rally? In the grand chessboard of the financial markets, there are 2 main types of players: institutional investors and retail investors. Institutional investors are often large organizations like pension funds or insurance companies that invest substantial amounts of money. They tend to have a longer-term investment horizon and are less likely to make impulsive decisions based on daily market fluctuations. On the other hand, retail investors are individuals who invest smaller amounts. They are more susceptible to the ups and downs of the market, often buying and selling based on emotions or short-term trends. The recent surge in Bitcoin's price has been largely driven by institutional investors pouring money into Bitcoin ETFs. These big players have been scooping up substantial amounts of the digital currency, creating a supply and demand imbalance that's pushed the price up. But it's not just about the money. The entrance of these institutional investors into the crypto market also brings with it a certain level of credibility and stability, potentially reducing the asset's volatility. Meanwhile, retail investors have been showing a preference for buying coins directly. This approach allows them to own the actual cryptocurrency and gives them more control over their investments. However, it also exposes them to higher risks due to the volatile nature of cryptocurrencies. So what does this mean for the rally? Well, the influx of institutional money certainly provides a strong foundation for the current rally, but it's important to remember that these big players are not immune to market corrections. They may systematically rebalance their portfolios from time to time, which could lead to short-term price drops. On the flip side, retail investors, with their tendency to react more emotionally to market movements, could potentially exacerbate these price swings. While institutional investment is a catalyst, it alone cannot make an entire asset class mainstream. As we move forward, it will be interesting to see how this dynamic between institutional and retail investors continues to shape the crypto landscape. Despite the wealth of applications for crypto, most of these uses are early stage or niche. What needs to happen for crypto to become mainstream? Let's delve into the crypto ecosystem and its myriad applications. It's a rich landscape, teeming with potential across a multitude of sectors, from payments and settlements to market making, lending and borrowing, and even extending to gaming, the metaverse, logistics, art, and copyright enforcement. Yet, many of these use cases are still in their formative stages or cater to a very specific niche target group. The question then becomes, how does crypto evolve beyond this? How does it outgrow the early adopter stage and become a ubiquitous part of our everyday lives? The answer lies in real-world utility and tangible innovation. While it's fascinating to ponder the potential of blockchain-based logistics or a decentralized metaverse, the fact remains that for a vast majority of the world's population, these applications remain abstract concepts, far removed from their day-to-day reality. What we need are crypto applications that touch upon the mundane, the routine, the ordinary. Applications that can streamline our daily tasks, make our lives more efficient, or bring about a tangible improvement in our quality of life. Consider this. What if a blockchain-based application could ensure that the proceeds from your morning cup of coffee go directly to the farmer who grew the beans? Or what if a crypto token could incentivize recycling and waste management in urban areas? These are the kind of real-world, tangible applications that could potentially catapult crypto from the domain of the tech-savvy early adopter to the mainstream. But it's not just about creating these applications. They need to be user-friendly, accessible, and easy to understand. The typical person is not a tech whiz, and if the entry barrier to using these applications is too high, they will simply not be adopted. For crypto to become mainstream, it needs to solve problems for more than just a tech-savvy user group. It needs to offer solutions for everyone, from the tech enthusiast to the average Joe, and it needs to do so in a way that is easy, accessible, and adds value to their lives. Oh, Google Trends show increased searches for crypto and Bitcoin. What does this mean for potential investors? We're in the throes of a fascinating phase in the crypto cycle. A surge in interest, as indicated by Google Trends, often corresponds with a heightened state of activity within the crypto market. This influx of curiosity could be the harbinger of a new wave of adoption, an opportunity that potential investors might want to consider. Let's dissect the current position in the crypto cycle. Following a colossal rally led by Bitcoin, there's been a 60% increase in crypto's total market cap since the start of the year. This uptick is largely attributed to the approval of spot Bitcoin U.S. ETFs, which has attracted significant inflows and created a supply-demand imbalance, driving up the price of Bitcoin. However, a word of caution is in order as crypto remains a nascent and niche asset class. It's still dwarfed by traditional assets like gold and even single tech corporations like Microsoft. So while the rally is impressive, it's crucial to keep things in perspective. Now, how does one participate in this crypto market? First, education is paramount. Understanding the fundamental concepts, technology, and dynamics of the crypto market is crucial. Second, consider your risk appetite. Crypto investments can be volatile and unpredictable, so it's vital to invest only what you're willing to lose. Diversification, too, is key. Don't put all your eggs in one crypto basket. Explore a mix of established cryptocurrencies like Bitcoin and Ethereum, as well as promising altcoins. Lastly, stay updated. The crypto market is rapidly evolving. New developments, regulatory updates, and market trends can significantly influence the value of your investments. Subscribe to reliable newsletters, follow industry experts on social media, and join crypto forums to stay in the loop. As we navigate this exciting crypto journey, staying informed and understanding the market dynamics remain key to successful participation. With the right knowledge and a measured approach, you can participate in the crypto market and potentially reap the benefits of this digital revolution.